Alright, so let's go ahead and get right into it. What's up, everybody? Welcome to the channel. My name is Garrett. You're here with Garrett's Stock Thoughts. I'm super glad that you guys are here. And I'm really excited about this video because today what's on deck is a Lyft fundamental analysis. As you guys know, there's been some pretty serious IPO action going on recently. We've had Lyft, Uber, Pinterest, so today we're going to be going over Lyft. And just to kind of preface this video, I wanted to ask you guys to do me a quick favor, and if you guys like the style of this video, I kind of just went with it, so I kind of made a chart with all the information on it. If you guys like that style, go ahead and let me know. And if you guys want something that's a little more, me interacting with you guys, just drop a comment. I want to make the best possible content for you guys. So with that being said, let's kind of jump right into the fundamental analysis. So the way that I want this to work is I kind of broke it down into three main sectors. So we've got the global climate section here. We've got the sector of the market, so tech, ride sharing, and then lastly, we have the company, which is by far the biggest section. So my plan is to start sort of at the top with global climate and work my way a little bit more granular each time as we go from global climate to sector and then finally into company towards the end of the video. So to start off, let's go ahead and dive into global climate. And I'm sure you guys have realized this and seen it all over the news, but there's been some crazy things going down in terms of the global news. The main thing being the trade war that's going on with China. And the interesting thing about the trade war is it seems to keep popping up, but I think by far this time seems like the most serious news that's come out. But then again, like in the past, it's been all this trade war news comes out and the markets go down and they react, and then it just starts to settle down and Trump has some sort of positive contact with China, and then the markets, they go back up again. So the trade war has always been super interesting to me because, in my opinion, it seems like a lot of saber rattling, but it also has the possibility, of course, to turn into something way more detrimental and important. I mean, it's obviously important now, but more detrimental to the market than it is currently. So moving kind of down the chart, and it sort of correlates with the trade war. So the U.S. has had a lot of tension with China, which has led to the U.S. making laws and restrictions about the parts that Huawei, which for any of you guys who don't know, Huawei is a Chinese cell phone manufacturer. So the U.S. is limiting the amount of American parts that Huawei can use in their phones. And, the big picture on the trade war and all this news is, yes, it is very scary, of course, to see all these things going out in the news, but to some extent, and the past year has kind of shown you, it seems like a little bit of saber rattling. So you kind of just have to be cautious, but at the same time, look back in the past year and see what's gone as the talks of the trade war have steamed up, then the market reacts and goes down, and as they've sort of calmed down, then the market creeps back up again. So moving into the economic climate, already kind of mentioned the trade war along with the tariffs. And just to kind of dive a little bit deeper on that, it's not necessarily more of a fear of the tariffs, but I think what people are afraid of is the possible disconnect that can be created between China and the U.S. as a result of the trade war. China and the U.S. have a very interconnected, their economies are very interconnected. And because of that, not even the tariffs, but a disconnect in that interconnected economies is probably the worst possible risk in terms of the global economic climate, because it would not only affect the US and China, but also anybody who does business with us. So moving kind of forward with that, the bottom line is, because of all of this fear, it leads to uncertainty, which is a very important word. Uncertainty in the market, uncertainty in the global climate, and in my opinion, with this uncertainty, there's two possible plays. You could take the Warren Buffett approach, be greedy when others are fearful, and buy the lows. Buy the lows, find some blue chip stocks that maybe you've been wanting to buy, but you weren't quite ready because the stock price and the valuation had just gotten way too high for you. So now might be a time where, maybe you have some extra capital sitting on the sidelines. Go ahead and pull the trigger. I mean, you're going to get it at a discount. That's 100% for certain. And then the second possible play is the cautious approach, which I think if this thing turns into something bigger, then people who are cautious, at least from the short to medium term investing and trading side, will probably be better off, because going back to point one, if you're cautious and you wait it out a little while, there might be a better entry a little bit down the road, because if things start ramping up, then more likely than not, the market's going to go down, which gives you a better opportunity to get into some of these blue chip stocks at a lower price. So now that we kind of have a picture of the global climate, I think we can start moving a little bit more granular into the sector itself, the tech and ride sharing sector. And this one's super interesting to me because the whole ride sharing business is extremely new. And, companies like Lyft and Uber, they really have been disruptive in terms of the technology that they have. Like, if I'm going to the bar Saturday night, I'm not even going to think about driving because, I have the option to go on my phone and pull up the Uber or the Lyft app and be like, oh, shoot, I can go ahead and get a ride for $6. All right, let's go. And then I'll go to the bar and I'll have a good night. So I think the whole sector itself has been extremely transformative in terms of, a new technology that's completely changing the way that people think about things. But because of the newness, there is sort of the downside in that because it's relatively new, people might consider the sector untested. And that could be a bad thing because there's no past data to go off of to make your decisions on. You really just don't know. You can't look back at the past and use the past to help you make your decisions. So I'd say that's definitely a somewhat of a downside to the sector. It could be looked at in a positive light of, there's new sectors popping up all over the place. The iPhone and cellular technology was a new sector. Don't you wish you got in then? Yes, that is definitely a possibility. But again, there's just no way to know that. So moving down kind of the chart here, the next item is no brand stickiness. And so the best way that I can kind of describe this cell in the chart is think about when you're using your ride sharing applications like Uber and Lyft. What is the main decision that you use to choose whether or not you are going to choose Uber or Lyft? At least for me, it's price. I always check both, and 9 times out of 10, I'm going to pick the one that is cheaper. That is no brand stickiness because you're not necessarily loyal to one brand or the other for any other reason. You're going to go with the cheapest price, which makes a lot of sense in my mind. These companies aren't necessarily doing anything to make you want to come back to their brand, but I think that's a negative thing because the more brand stickiness you have and the more loyalty you have towards your brand, it's going to give you an edge over your competitors because consumers are going to choose Lyft, for example, over Uber because they are loyal to Lyft. So continuing to move down the chart, just kind of going over some trends. One reason why sort of this ride sharing technology has become so popular is because of a couple common trends that, Lyft and Uber realized years ago when they started their businesses. And one of those is that owned vehicles are highly underutilized. I think there was some statistic that Lyft put out in their S1 document that said like 97% of cars are parked 97% of the time or something crazy like that. And that's just pretty insane to me. Super underutilized. And then, we spend all of this money every year attempting to maintain them. And Uber and Lyft are saying, oh, well, that's dumb. Why would you do that? Here, just use ride sharing. Another interesting point about the sector, and I was reading this in an article a couple days ago, was the high level of short interest. And basically what that means is you really have two options. You have more than two, but generally when you buy a stock, you're buying it in the hopes that it will go higher in price, because then you, the owner of the stock, will make more money. However, there is the option to short a stock, which means you are essentially betting that that stock price is going to go down. You're going to make the difference as if it was going up, but the reverse. So you're hoping that that price will go lower because that means that you're making money. And basically what this means is that there are a lot of people that are betting on not only Uber, but Lyft to go down. For example, Uber has $826 million of short interest, and Lyft has $1 billion of short interest. That's 61% of their float, and for Uber, it's 11.8% of their float. That's a lot. And one thing to keep in mind here is, yes, Lyft has been on the market a lot longer, meaning it's had a longer time period to build up this short interest, sure. But either way, these numbers are not small. Clearly, there's a lot of short interest. A lot of people are betting on these things to go down. And that's something to keep in mind when you're making, not that you should make your decision off of other people, but it's definitely worth noting that all of these people are betting on these companies going down. All right, so that kind of brings us, so we've gone over global climate, we've gone over sector, which, super interesting. Now we're going to get into the company itself. So now we are solely focused on Lyft. So the first topic that I wanted to cover in this analysis was the culture of Lyft. And I think the culture is one thing that definitely sets Lyft apart when it comes to Lyft versus Uber. Uber has had many problems in the past with their culture. They actually had to get rid of their original founding CEO and hire Dara, who was, I think he was the previous CEO of either Expedia or one of those companies. So Uber brought him in, and his goal was essentially to turn around the culture at Uber while also growing them, both internationally and into other sectors like food delivery and logistics. Just the fact that they had to completely bring in another CEO gives Lyft the edge when it comes to culture, for sure. Lyft's founders from the very beginning have been super duper. They really just wanted their culture to be something that was true and something that was sound, and they just wanted a good culture for their company because they felt like with good culture comes good performance. Good press is always a good thing. So I think Lyft definitely has a better culture than Uber when it comes to internally in the company. Lyft is also environmentally conscious. They do a certain amount of things every year where they're making an effort to save the environment, which I always think is a good thing, and that was also data from their S1 document. And like I mentioned before, they're able to limit the amount of bad press that they have, which is always a good thing. A couple maybe bad things are, recently they've been sued over their IPO. I think I read more into that, and I think it was only like the class action lawsuit was somebody filed it, and I think their position in Lyft was only like $3,600 or something, essentially minuscule, which is kind of crazy to me why you would be suing over that. And then the second point down here is I think this is a problem for both Lyft and Uber, but just the disgruntled drivers, drivers feeling like they're not being paid enough. I think there was some sort of strike possibility going on in the near future. So again, just things to keep in mind when making this decision. Okay, so moving into the business model, which I'm going to spend a good amount of time here because I think it's super important to realize how this business works if you're going to then make an investment in it. So the one thing that differentiates Lyft from Uber is their single focus on transportation. And what I mean by that is Lyft has explicitly said that they are only staying in the transportation business. They might do that in more ways than one, meaning, yes, okay, so they've got ride sharing with cars, and then they've made efforts in scooters and even shared bicycles in the cities and stuff like that. But their primary focus is on transportation, nothing else. And I think that can be a good thing and a bad thing. And I'll go into that in a little more detail. I just want to do a quick comparison. So with Uber, they have their toes in a couple different industries. So they've got ride sharing, they've got the food delivery service, and then they also have a logistics service. So they're not only focused on transportation. They've got their hands in a couple different industries, and I think that can be a good thing, because in terms of Lyft having a singular focus, because like I mentioned earlier in this video, ride sharing is a super new business model. And I think if somebody's going to get it right, then they should probably be putting all of their focus on it. And I think it's going to give Lyft maybe a leg up in terms of the growth that they're going to see on the ride sharing side of things, maybe in the long run. So how does Lyft draw new business to their app, and what are they doing right now to really grow the overall ride and user growth? And one way that they're doing that is through promos and discounts. I know Lyft does a ton of promos and discounts. I see them pop up on my phone all the time. And I'm not going to lie, it kind of gives me a little bit more incentive to use Lyft, because I know, I'm going to get $1 off here. Going back to earlier in the video, for me, it's all about price. So that's one way that they are growing their, using marketing to grow their sales. So moving down the chart, next thing is transportation as a service. And this is, sort of the overarching business model, and super interesting to me, because with transportation as a service, you've got kind of 2 or 3 main facets. So you've got, the people who are seeking rides, and then you've got the drivers who are giving rides, and you have to somehow figure out, okay, how do we have enough drivers to drive all these people around, and how do we have enough people who need rides so that the drivers have people around? So Lyft does some pretty interesting things to make sure that supply and demand is met. One of the things that they do is something called dynamic pricing. And how this works is, I'm sure you've probably seen it if you've used the app. Pretty much, if you go on your Lyft app and it's a super popular time, your price is going to be way higher. And that gives these drivers incentive to go towards that area, because it means that they're going to be making more money for your ride versus somebody in a less popular area. So it's pretty cool. It's dynamic pricing. The areas change as the traffic goes down and up. And honestly, I think it's a pretty cool algorithm that they've implemented. Another thing is the trends in mainly the US and sort of this generation of people. And some of these trends are going from a state of, okay, our parents and sort of the baby boomer generation was more, okay, I want to own this. I want to have complete ownership of my car. I want to have complete ownership of my house. I want to, I'm not going to rent. I'm not going to lease. And that's kind of a shifting trend where the millennial generation is looking less towards ownership and more towards just paying for the service, not necessarily owning the service that they're paying for. And I think that's definitely something that Lyft is capitalized on, because car ownership, I think especially in the cities, it's going down with the millennial generation. As I mentioned before, cars are highly underutilized. They're parked for 97% of the time. They super expensive to maintain throughout the year. So I think Lyft especially is trying to capitalize on some of those trends that are occurring all over the US and probably the world right now. So moving forward, the big question is, can these ride-sharing companies, and specifically Lyft, reach profitability? And that's super interesting question. Just for a quick sort of, what does it mean to be profitable for all of you guys that don't know? Profitability comes when, as a company, you have all of the revenue that you're making, which is the money that you're bringing in, and then you have to cover your costs of revenue, which means, okay, I spent this much money in order to make this revenue. So that could be anything. There's a lot of different things that fall into that category. And then you have the money that it takes to simply operate as a business. So, paying your rent, all that kinds of stuff. So companies like Lyft that are not profitable are not making enough revenue to cover their cost of revenue and their operating expenses. And Lyft has had some pretty interesting numbers when it comes to their revenue. And just to kind of give you guys the exact numbers, and this is from their quarter one earnings. So in Q1, Lyft made $776 million, which, that's a lot of revenue. That's double the amount from the same quarter a year ago. They have a 46% and 95% active rider and revenue growth year over year. So 46% growth in active riders, which means there's 46% more riders year over year this year than there was last, and 95% revenue growth year over year respectively. And they've got 20.5 million active riders, which that's pretty significant. And in terms of another part of their earnings was the guidance that they released, and they actually had higher expectations than analysts expected in terms of the full year revenue that they're going to make. It was an expectation of $3.26 billion, and the actual guidance that they gave was $3.27 to $3.3 billion. So they beat there. The Q2 revenue was expected at $782.2 million, and they guided at $800 and $810. So that was another beat. So I think that it does suggest a year-over-year slowdown in revenue growth. So they're saying that, yes, year-over-year, Q2 2019, they're expecting to be bringing in less revenue than Q2 of 2018. But either way, the growth is still there. But the problem is the losses that they're experiencing. So they've got, they're expecting steeper losses to come in quarters to come. Full year adjusted operating losses, they're expecting anything between $1.15 billion and $1.175 billion, which, is a lot of money. And I think that from an investment perspective, when you see, you're super pumped about these growth numbers. It's pretty awesome to see Lyft, taking market share away from Uber in the ride sharing segment, being able to grow their active riders at the rate that they're doing it, have the revenue growth that they're having. But the problem comes in, as an investor, yes, growth is a huge factor in your investment, but at some point you're looking for a return. So the question becomes, can Lyft become profitable? And I think some of the main factors going into that are the amount of money that they're spending on sales and marketing to have these kind of growth numbers. And then, obviously their operating costs are extremely high. So if they can't figure out a way to get these costs down, and they can't ever figure out a way to make their business model profitable, as an investor, why would you ever take the chance on that? If they're not going to become profitable, you've seen what's going on with Tesla recently. At some point, they're going to have to seek more funding, and with more funding comes a higher valuation, which means as an investor, that's potentially a good thing, but you're trying to get in at a lower valuation. And if you're not profitable, there's going to be a problem down the road, as you guys have seen with Tesla. And the last sort of portion is where's the money even going? And the majority of that money is going towards sales and marketing, which it's driving the growth that they have, and they're trying to eat up as much market share as they possibly can, steal as much away from Uber, which makes a lot of sense. But at some point, as a company, you need to reach profitability. Doesn't necessarily need to be in the near term, but at least have a plan. And I think that's one of the problems with these ride-sharing companies, is that there's no plan to reach profitability. So that's a little bit about the business model. So the last sort of column that I've got here are the risks, and these risks are coming directly from the company's S1 document that they gave to the SEC when they filed for an IPO. So one of the risks is attract and keep qualified drivers. And that's kind of a legitimate risk with all these drivers potentially going on strike. That's a problem. They need enough drivers to supply the demand of all of the people requesting rides. So number two, I've mentioned this a good amount already, but there's no concrete plan to reach profitability. I read an article the other day of somebody who had an interview with the CEO of Lyft, and when he asked him, hey, like, what's your plan to reach profitability? The CEO was like, oh, we're not, we're going to get there. But right now we're focused on growth. And, you can say that and that's great. But at some point you need to sort of have a business model that's going to allow you to be profitable. And I think, just a quick side note, I think for every $12 Lyft is spending, or for every $12 that you're spending on a ride, I think Lyft is spending $17 on that ride. So that kind of shows you the difference in how much money that they're losing per ride. So another portion over here is new regulation in the industry, and they kind of had to fight that earlier on in the ride sharing business. When they were trying to fight the taxi cab, all the people who were doing the taxi cab stuff and just dealing with the regulation. But there's still the possibility, because this sector is so young and so new, that regulation comes out that can negatively affect their business. So that's something that they pose as a potential risk. And last but not least is autonomous driving. I think I read another article that said the only way that Lyft is going to reach profitability is if autonomous technology becomes a thing in the near to medium term future. And one of the risks with autonomous driving is, number one, does it actually progress to the point where you've got cars autonomously driving themselves with no, at least a human guide in the car? Does it even get to that point anytime soon? I personally think we're still a little bit ways away from that. Companies like Tesla are doing good things, but I don't think we're where we need to be for that to happen. And then secondly, what happens if people just don't buy into the thought of getting in a car that's driving them without a driver? And that's a legitimate concern. I mean, I think the argument can be made, oh yeah, like all the people who flew airplanes for the first time, why did they do that? They took a chance on it, but it's just a possible risk. And I think that was something that they saw as, okay, what happens if the consumers don't actually buy into the technology of autonomous driving? It can have a poor effect on the potential future of the company. So now we've gone over kind of all the columns here. You guys have seen the global climate, what's going on in the sector, and then the company. So I'm going to go ahead and wrap things up, everybody. Like I said at the beginning of the video, please let me know how this chart, if it was something that you guys enjoyed. I can go ahead and link a description to it, or maybe just put the file in the description for you guys to have access to. Let me know. I'm trying to make content that you guys enjoy, so I have no idea if this is something that you guys like or if I should do something a little more interactive, but thank you guys for tuning in. I'm going to have some videos hopefully coming out in the next couple days. I've got a video going over Uber's IPO, so that's something that you guys can look forward to. Definitely enjoyed this video, and I'm looking forward to seeing all you guys in the next one. Thanks for tuning in, guys.